Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. And this week's topic, guys, is day trading or swing trading. I get this question all the time. Jared, which is better, day trading or swing trading? Which one makes more money? Which one should I do? Blah, 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 blah. Guys, we're going to talk in depth about the differences between intraday trading and swing trading. We'll even talk about core trading and investing a little bit as well. In my personal opinion, if you're able and you have the time, you should be doing both because all forms of trading are profitable. It's just a lot of it depends on your time constraints, your financial constraints, your personality constraints. So we're going to dig deep into those specific topics today so you can fine tune your trading and sort out which one is likely better for you. Now, again, ultimately, professional traders are doing a little bit of each of those because they want to maximize their profits, right? One is an income producing action and the other one is a wealth producing action, all right? So it's a very important lecture if you're trying to build wealth or even create income. So sit around, pay attention. If you like these videos, please click that like button, hammer that subscribe button. Don't forget those click notifications as well. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is day trading versus swing trading. Which is better? I get this question a lot through email, sometimes in the chat room even, and a lot of people say, well, which one should I do? I'm a new trader. Which one should I start with? Day trading, swing trading, or even core trading? And it's not that simple per se to answer. A lot of it depends on your individual situation, which we're going to talk about here today. And this, again, is a good time to be talking about it because right now, in the beginning here of 2023, the markets are, coming off a pretty nasty year. This is a good time, in my opinion, to be swing trading and core trading, especially core trading and adding to your long-term portfolio. But that also doesn't mean that day trading isn't valid and that you can't make a lot of money day trading. Anyway, it's a topic that I think, again, is very relevant to where we're at in the markets, as well as just trying for traders to try to figure out which is best for them. Ultimately, in my opinion, you should be doing both. So after we get through this whole hour-long lecture, at the end, we're going to sit here and say, yeah, ultimately you should be doing both, all right? Because one is income producing and one is more of a wealth building venture, all right? All right, let's dig in. Characteristics, right? Intraday traders are looking to take advantage of short-term moves, maybe 5 minutes to 2 hours, right? Could be 30 seconds, could be 4 hours, right? Protect profits as a stock moves higher, unwilling to give too much back, okay? Looking for daily, weekly income to pay everyday bills. This is the general gist of intraday trading. Now, keep in mind, there is a big range when we talk about these topics. When you say looking for daily, weekly income to pay everyday bills, this doesn't mean that there's no savings here. I mean, your bills could be expensive, meaning you could go make $50,000 or $100,000 a month intraday trading, even scalping, if you will. It just depends on your size, your frequency, et cetera, and so forth. So when it says weekly income to pay everyday bills, don't look at that as like, oh, well, there's no money in that. I don't want to do that. There's tons of money in that. Okay, and sometimes you can take that quote-unquote income type pay and move it into core trades, longer term positions, okay? But the general gist here for intraday traders is it's a shorter time frame. You're not staying in these stocks as long and you're not looking for those monster 5, 10, 15-hour moves, all right? Whereas swing traders are looking to take advantage of longer term moves. A few days, maybe even up to a few months at times, okay? It gives, you give the trade more room when managing to allow for pullbacks and larger gains. The key here, guys, when you think about swing trading, simply this: the goal here is to stay in it, right? To stay in it as long as possible, because if you're swing trading properly, you should be trend trading, which means on the daily or weekly chart, maybe even monthly chart, the stock is in a power trend. Up or down, it's in a power trend. And you want to fully take advantage of that power trend. And those trends can last a very long time. So Swing traders are a bit more patient. They're going to give their stop losses a little bit more room, and they're not going to get crazy nervous if a stock pulls back a little bit. Whereas if you're intraday trading or scalping, you might say, you know what, this isn't doing what I want. I'm moving away from it. Whereas swing trading, you're going to be more patient and give them more time. You're looking to build their portfolio and gain wealth. Now remember, you can still swing trade for income. Right? You could say you don't have the time to intraday trade, right? Let's say you have a job and you're like, you know what? I can't be at the market at 9:30, but I do have a couple hours a day to look at the markets, maybe 1 o'clock to 3 o'clock. Okay, well, you can choose to intraday trade that time, or you can say, you know, I'm going to pick a few swing trades. Or maybe you don't have any time throughout the day, and post-market, you choose your positions post-market, and then you put your orders in, and then you come back the next day to see if those orders were filled. That's a possibility as well, okay? So a lot of people will divide their trading down to long-term, medium-term, short-term. You know, we like to look at them basically as long as short-term. Medium-term, I guess you could, but the one thing you need for all trades is this. You need a bias time frame and an entry time frame. Always, for everything you do. There's a time frame of bias and there's a time frame of entry. Okay, so the bias time frame is the trend frame, right? Now, when you are looking at core trades and swing trades, that bias time frame is going to be a weekly or a monthly chart. If you're intraday trading or scalping even, that bias time frame is going to be a 15-minute, a 60-minute, or a daily, almost always. 15, 60, or daily. It just depends on, you know, how much you're intraday trading in terms of, are you scalping on a 1-minute chart or are you trading on a 5-minute chart? So if you're scalping on a 1-minute chart, you could use a 15-minute, 30-minute, 60-minute as your bias. If you're trading 5-minute charts, you're probably going to use a 60-minute or a daily for your bias. And then, of course, your entry is going to be the lower time frame. And you want to make sure you always have multiple time frames in alignment. We never, ever trade in a vacuum. Example, Cass took a scalp, right? Some Qs puts today, all right? Cass took a Qs scalp today on some puts, based off of a 30 and 60-minute double top on the higher time frame. So the bias, even though it was a scalp trade, was still short. That bias came from a higher time frame, but then used basically a lower time frame put to get into that and get out quickly. All right, but there was still a bias and an entry there. And this does, I don't care if you're a core trader or a scalper. You have to have both of these to be a good trader. Okay, so if you enter trades on the 1, 2, 5, or 15-minute, you're an intraday trader. If you enter trades on the 60 or daily, you're basically a swing trader. And if you enter trades on a weekly or monthly, you're a core trader, right? And that's pretty much it. Now, can some of these have some overlap? Sure they can. Some crossover? Sure they can. Okay. Now, debatable, positives and negatives, right? People look at things differently sometimes. So if you are swing trading, right, scalable to a much higher level, that's a fact. Right? You can take much higher risk on swing trades because you're taking much wider stop losses. Like if you're trying to get a 10 or 20 or 30 cent stop loss on an intraday trade, it's kind of hard to get 100,000 shares to that, isn't it? If you're swing trading with a $5 stop loss, it's a lot easier to get 20, 30,000 shares, which might equal the same amount as that other trade. Does that make sense? So it's scalable to a much higher risk level. You don't have to sit at your desk all day. Right? You can kind of set your bracket order and forget it. You can take your time evaluating the pattern in the trade. This one's a big one for new traders, right? A lot of new traders are very, what's the word? They're green, so they don't have the pattern recognition yet. So when you're on a 2-minute chart, you have to make a decision. Yes, that's a good 2-minute buy setup. That's a good 1-minute buy setup. That's a good 5-minute buy setup. When it's on a daily chart, it gives you hours, literally hours to look at it. Check the book, check your notes, check your trading plan, go, oh, okay, this check. There's my checklist. No problem. Okay? When you're doing that on a 2-minute chart, you better get through that checklist in about 20 seconds. If not, you're going to probably miss the trade, right? Level 2 and slippage is less important. Why? If you have a $5 stop loss and you take 30 cent slippage, that's not that big of a deal. It's less than 10%, 7% slippage. If you have a $1 stop loss and take 30 cent slippage, it's 30%. Right? So the percentage of slippage is usually less, and HFT shakeouts can be less common unless, of course, we have some nasty news in the market, and lately the market goes down $5 or up $5. But you're probably not going to get shaken out quite as much because, again, you're giving them so much more room. Now, perhaps some of the negatives, there's less frequency. One of the reasons is there's less leverage, right? Down here it says only 2-to-1 leverage. So less frequency due to less leverage, and there's probably maybe fewer opportunities out there, right? On an intraday 5-minute chart, you can probably find 3 or 4 entries on the same stock throughout that one trading day. On a daily or weekly chart, you're not getting 3 or 4 opportunities per month on that trade. You have to go to a different stock symbol. So there's probably going to be less frequency. You're going to take longer to hit targets. Instead of hitting targets in 5 minutes or 50 minutes, it might take you 5 days, right? It might take you 5 weeks sometimes, okay? Overnight risk of news reports is really kind of the biggest thing you're looking at, right? Obviously, earnings is something you decide. You're not going to hold through earnings, so that's your choice. But when it comes to news reports, yeah, they can adversely affect stocks in a big-time way. The CEO gets fired. An accident happens at the Amazon plant, all right? Something. Elon Musk buys Twitter, and it affects Tesla, right? Those types of things can be a problem. So those are some of the negatives. Now, on to day trading, more frequency can mean more money, right? You could come in and take 10 trades a day. You're not taking 10 swing trades a day. It's not going to happen. You might take 10 a month, but not 10 a day. So you have the advantage of frequency. So what you lack in huge targets, you could potentially make up in frequency. You don't have to wait days or weeks to hit your target. You get much more leverage, double, in fact, 4-to-1 versus 2-to-1. Level 2 and slippage is more important. So whether that's a positive or negative, it could be a positive because you can read the level 2. Like Amazon today, I saw like 105,000 shares at the whole number at 93. Now you can play that. You know you're probably going to get at least a 10 or 20 cent pop. So the level 2 can become more important in a positive way. All right. You have to scan every day. Swing trading, you don't really have to scan every day. You should, but you don't have to. You could probably scan once or twice a week. Okay. Have to sit at your desk for an hour and a half to 2 hours. Right. Now again, I think most people don't find this to be a negative, but it could be if you have a day job. Right. Maybe you don't have 2 hours a day to sit at your desk. Right. Maybe you have a full 8 to 5 job on the East Coast and the market's bam, smack in the middle of that day. It's not as scalable. While it is scalable, and you can certainly scale to pretty big levels, it's definitely not as scalable as swing trading. You should understand basic level 2, whereas with swing trading, you don't really have to understand level 2 at all for the most part. You should know what the spread is, but you don't really need to understand level 2. Easier to get shaken out of because you have tighter stops. Need to be quick and precise with your orders. And platform or tech issues can be more common. They shouldn't be common, but they could be more common. So those are some of the positive and negative things that we see in day trading and swing trading. All right. So which is better? It depends. What are you trying to accomplish? Right. So when you think about it, it really comes down to these 3-4 things. Right. It comes down to personality traits. What type of personality do you have, right? Do you have a jittery type personality? If so, you might be better at scalp trading, right? Because you might not be able to hold those swing trades. You might check it, you might be at your day job and check your swing trades on your phone every hour. That's not good. That's like buying a long-term investment that you plan to hold for 10 years and checking it every day. That's ridiculous, right? Well, that's what some people do, okay? Time constraints. Again, you may have a day job and you can't look at these things all the time. So swing trading might be better for you. Or maybe you have an hour and a half a day to trade and that's all you have to trade. So maybe scalp trading is better for you because you only have an hour and a half. So it really depends. And then, of course, capital restraints. It's interesting because they can conflict, so to speak. Meaning sometimes you need less money to swing trade. Sometimes you need more money to swing trade. You're like, well, what is that? What do you mean, Jared? Well, if you're only taking one swing trade at a time with very small risk, swing trading requires less capital. But if you're taking multiple swing trades at a time, say you have 5, 6, 7 open positions at one time, which is possible, okay, it's going to require more capital because you only have half the leverage. Right? Now, in terms of getting above or below the pattern day trading rule, 25,000, the PDT rule, swing trading is better because at least you get 3 trades per week, right? On a rolling basis, 3 trades per week. So it probably requires a little less money to swing trade, right? Than it does to intraday trade. And then, of course, intangibles. This goes back to kind of personality traits, but a little different. Intangibles would be, are you someone who is tech savvy? Are you someone that can multitask? Right? Can you multitask quickly and look at 5 different things at the same time? If so, intraday trading is probably okay for you. If not, you're slow to do everything, you're very deliberate in your approach, and you take time for everything, then swing trading might be better because it happens over a longer period of time, so you have a lot more time to think about things and how they're going to go. Okay? And when it comes to patterns, it doesn't matter. This is the beauty of trading in general. Right? This is the beauty of trading in general. Okay? When it comes to patterns, they're all the same. Swing trading a 1-minute chart, core trading a monthly chart. A buy setup's a buy setup. A breakout's a breakout. A turnaround bar's a turnaround bar. Parabolic's a parabolic. It does not matter what time frame they're on. That's the beauty of trading. When you look at one of these candlesticks that you see on this screen, you can't tell me that that's a 5-minute chart on the top. You can't tell me this is a daily chart on the bottom. You have no idea what it is. Isn't that awesome? So when you understand patterns and understand technicals and support and resistance, just erase the time frame from it. That's the beauty of it. So the patterns don't really matter in terms of, some people ask, well, are certain patterns better for swing trading or intraday trading? The answer is no. They're all the same. They're all the same. Okay? They just happen on different time frames. Okay? Now, this is what I mean by trend trading. If you are swing or core trading, and this is a weekly chart, some of you guys have seen this before, but note, this is a clear and concise downtrend. Okay, when you finally get that double bottom retest, you break above the trend line, above the rising moving average, put in a higher high, a higher low and a higher high. This is clearly transitioning. Now, if we're right about the stage this stock is in, because again, occasionally we'll be wrong, occasionally we'll be wrong, but if we're right, this is the bottom, right? $23 is the bottom. And this is a pretty smooth move down. So realistically, it may take a while. In this case, it's a weekly chart, but it has room back to $60. So if you happen to find an entry like we do here at 27 with a stop at 26, my goodness, the possibilities are endless. Endless. Moves up, pulls back, moves up, pulls back. You can add to your position. You're going to ride this gravy train back to 40 or 45 bucks. 10 to 1, 12 to 1, 20 to 1, right? This is harder to do on an intraday trade because, they're shorter moves over a shorter period of time. Now, can this same pattern present itself on a 5-minute chart? Of course it can. Of course it can. But when you find these on a daily or weekly, it's the gift that keeps on giving, all right? And on top of it, with a wider stop loss, if you have a $27 stock on an intraday trade, you're probably looking at a 20-cent stop loss on that. This stop loss is 5 times bigger. 5 times bigger means share sizing is less important. It's easier to buy 10,000 shares of this because it's a $1 stop loss. And if you get filled if you get filled 5 or 10 cents late, it's no big deal. If you get filled 5 or 10 cents late on a 20-cent stop loss, that's a problem. That's 25 to 50%. That's a problem. Okay? So getting filled a little bit later on this isn't as big of a deal. But the reward here is amazing, right? You're already up 10 to 1 over here, and it looks higher. Okay? Now, on a lower time frame, same thing. You guys have seen this. I think this is in Trading Plan Essentials, this slide, right? Wide bar, narrow bar, rip. Okay? In this stock, $1.80 up to $4.50, $4.60. That's a huge move. It's almost $3 on what? A pretty tight stop, 25-cent stop. So what am I getting at? I'm showing you both sides of the coin. What I mean by both sides of the coin is I am showing you how an intraday trade can potentially make as much as a swing trade in terms of R, right? Hey, both trades could make 5R. Both trades could make 10R. But risk-wise, it's way harder to get, let's say you want to do $10,000 risk. I'm serious, I'm not kidding. Let's say you wanted to do $10,000 risk on this trade. Well, 25-cent stop loss, $10,000 risk, you're going to need a lot of shares, right? You're going to need 40,000 shares. To be able to get filled for 40,000 shares without taking significant slippage is going to be tough. To do $10,000 risk on the last trade we saw, you only need 10,000 shares because it's a $1 stop loss. Okay? Now, granted, in this case, 40,000 shares would be cheaper because it's a $1.80 stop. But what about over here? What if you get in at like 105.70 and your stop is 106.20? It's a 50-cent stop loss, but it's a $100 stock. Now doing $10,000 risk is more challenging. But if you'll note, the move was still pretty darn good. Okay? So risk level tends to change. All right? When you take these, it's funny because we're looking at CRWD today. You can see how old this is. CRWD is significantly above this area. But the point is, scaling out your trades is a lot easier to do with swing and core trading. So that's why I call it wealth building. Because you do $100,000 risk on a trade. Yeah, you may need $1 million account. That doesn't matter. Doesn't matter. I'm talking for people really wanting to build true wealth. I don't look at $100,000 as wealth. That's income. Okay? So when you look at that, income or intraday trading is wonderful, but it has its limitations. And this is why I said earlier, ultimately, the ultimate goal is to do what? Do both. The ultimate goal is to do both. Okay? Here's another example. Wide range bar taking out support. Narrow range resting bar, narrow range resting bar. Your entry, again, same trade we saw earlier, 106.70. And then the stop is like 107.20, etc. And it goes down about $4, $3. Great. Right? Same here. This particular example on the right is one that you could turn into a swing trade. Right? And you can still get good risk. I'm not saying you can't risk $2,000, $3,000, $4,000 on an intraday trade. You can. I mean, I risk a couple grand every trade, right? But you're not risking 10, 20, 30,000 on an intraday trade. You know, the liquidity, the amount of buying power that you're going to need potentially, getting skipped on the trade or partial filled or getting late filled, you're going to have to anticipate so early it's going to be more challenging. Okay? Here's an example of a 3-bar play. If you note, the last slide and the slide before that were what? They were intraday 3-bar plays. Right? What's the difference? Nothing. The answer is nothing. The characteristics, wide range igniting bar, narrow range resting bar, they're the same. The only difference is instead of these being 5-minute bars, these are daily bars. So you have to hold the stock 1, 2, 3, 4, 5, 6 days in this case versus 30 minutes. 5 times 6 is 30. But look how much money you could make. $18.50 by $17.75. It's a 75-cent stop loss, and the thing went nearly $12, $11. That's what? 13 to 1 on your money? Crazy. Same over here. You get in at $20, your stop loss is 18. It's $2 stop loss. It went to $40 1, 2, 3, 4 days later. Now, granted, are these incredible examples? Of course they're great examples. But it shows you the potential. You could have made 10 to 1 in 4 days, but look how many shares it prints as well. Right? This is a stock that you could have easily bought 10 or 20,000 shares of. Do the math. 10,000 shares of this is $20,000 risk. 20,000 shares of this is $40,000 risk, and it would have been no problem to get it. No problem. All right? So scalability definitely favors swing trading. Okay? Now, in terms of scanning, they're similar. They really are. I mean, you're using the same tools to scan for. Right? So when you're looking at, say, scanning for day trades, I'm using dollar gainers and dollar losers. Okay? You know what I use to scan for swing trades? Dollar gainers and dollar losers. The only difference when I'm scanning for a morning watch list versus scanning for swing or core trades specifically is the time frame. So you'll note on this, it says 5-minute, 15-minute, 2-minute, 60-minute, and daily. Well, if I were scanning for swing and core trades, I would still have the daily and the 60. But instead of having a 5, 15-minute, or a 2-minute, I would replace those with weekly and monthly charts. Right? I would keep the 60 and the daily, and I would replace these with weekly and monthly charts, especially if you're swing and core trading. Swing trading, you might use a 60-minute for a possible bias or an entry. Core trading, you're going to use the daily and the weekly for that, but I want to still look at the monthly. But you're going to do the same thing. You're going to pull up your dollar gainers, your dollar losers. You're going to go down the list, click, 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 click. Okay? Now this, you're going to take these ideas like VBLT, and you're going to put it on your gap list, your little thumbnail charts and your symbol list, and they'll be all on the right-hand side. Swing trading, you're going to do the same thing. You're just going to label it differently. Swing trades, intraday trades, gaps, daily watches. That's it. You're just going to label the symbol list differently. That is it. Okay? So here's an example. Here's a beautiful gap. All right? Level 1 gap from 27 all the way up to $30. Lots of shorts got squeezed, increased volume. Guess what this is? This could be both. This could be a stock that you put on your intraday gap list, but it does such a nice job on your intraday trade that you hold on to it, and we turn them into an intraday swing trade, right? So this is the best of both worlds. It's such a good gap. It should completely change the direction of this stock for weeks to months to come. I'll repeat that. It's such a good gap, such a powerful, potent gap. It should change the direction of this stock for weeks and months to come. If you can find an intraday entry on a 5-minute chart, buy it, sell at your target, but only sell half of your position and hold the other half for a swing trade. Beautiful. What are you going to do? Put that stock on your list. This is for intraday trades, right? There's your first favorite, your second favorite, long side, first favorite, second favorite, short side. And you can see, guys, I do this every day. Do I not do this every day? Of course, I do it every day. Today's favorites, just as an FYI, were Tesla over 123, Microsoft over 231, LTHM over 22, and CRM. In fact, 3 of the 4 of those crushed it today. Crushed it. And you literally put them in order. All right? Here's the gap list. Here's the favorites list. That's for your intraday trading. Guess what? You do the same thing for swing trades. You make a long daily watch list for swing trades, and you know what you do? You pick out your 3 or 4 favorites that are the closest to triggering. So you may have 30 ideas on your swing watch list, okay? And they're ideas that haven't triggered yet. They're just like, oh wow, this is a breakout that's forming. Wow, this is a buy setup that's forming. And say from those 30 ideas, you're going to pick your 3 or 4 favorite ideas, and those favorite ideas are the ones that are closest to triggering, the ones that are most likely that you're going to be into the soonest, okay? And then what do? You use multiple time frames. That's it. You use multiple time frames. Hey, there's the gap. There's the room. Let me drill down. Oh, there's the 5-minute. There's the 2-minute. The 2-minute gives you a little bit of a breakout. The 5-minute gives you a little bit of a 3-bar play. You're in at 17. Stop 16.75. Rip. Goes $1.85. That's how you trade. Swing trading's the same. It's the same, except on a swing trade, you probably wouldn't just randomly buy this gap, right? You could turn this into an intraday swing. The difference is it hit its target the first day. So you probably wouldn't because it hit its target on the first day, okay? But the process, right? So now we're going to do scanning for swing trades. You're going to find out the process is very, very, very similar, okay? I use dollar gainers and dollar losers for swing trading, but I will also use FinViz. Why? It's free. And I will use a universe. So you'll see right here, okay? You guys have seen this before. FinViz, it's free, finviz.com. You can put your parameters in. So I want, for example, hypothetical, I want NASDAQ stocks, okay, with a market cap of over 300 million. That's a pretty small market cap. I would recommend stocks with over $1 billion market cap. Index S&P 500, average volume over 500,000, country USA. Why? I'm not a big ADR fan, and price over $3. So those are the basic parameters. And when you do those basic parameters, you can save the portfolio, okay? And you can hit refresh and boom, it'll populate. And when it populates, in this case, it came up with 125 ideas that meet those parameters. However, we don't know if those are good ideas or not. They just meet our basic criteria. So then what you're going to do is you're going to click on AAL. In fact, you don't even have to click on it. You can just pan over AAL and a chart will pop up. And you go, ooh, that chart looks good. Ooh, that chart doesn't look good. And you go next, 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 next. That's all you do. Next, 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 next. Go through these 125 stocks, probably take you 15 minutes. And all of a sudden from 125, you dwindle it down to maybe your top 20 favorites. And you're going to put those on a list. Now, you can do this twice. So now, instead of NASDAQ, I'm going to do it again. I'm going to go over the NYSE. Okay? Same parameters, but now instead of NASDAQ, it's NYSE. Same again. Average volume over 500K, country USA, price there. Oh, 329 ideas. Save the portfolio. Go down, pan over it, pan over it. A chart will pop up once you pan over it. And you look, oh, good or bad idea, good or bad. Next, 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 next. So in this particular case, there's about 450 ideas to look at. And of those, you might like 10% of them, 40 or 50. And of those 40 or 50, there might be 10% of those that are ready. And you're going to do this a couple times a week, 2-3 times a week. And you're just going to just kind of go over the list. You're going to add certain ideas, take away certain ideas. You're going to add certain ideas, take away certain ideas. Okay? Gainers and losers. And note, daily longs, daily shorts. There's just a list of ideas here. And then, again, you're going to have a second category that's kind of immediate longs. Meaning, these are your daily swing ideas on the right-hand side. However, they're not necessarily all ready to trigger yet. You might need to wait a couple days or a week. Those you're going to put in a separate area. And again, I use dollar gainers and dollar losers, okay, to look at that. Organize things and you won't have a problem, okay? So then you go and you build your universe of 300 to 500 stocks that meet your basic scanning criteria. And I kind of went over it on the last slide. Say New York and NASDAQ stocks. You can use Amex if you want. Above 500,000 daily volume. Okay, cool. Price above $5 but below 500. It's just an example. You may not like trading $200, $300 stocks. They might be too whippy for you, perhaps. So you're going to kind of lower that to say maybe $5 to $100 stocks. Okay, fine. Country of origin, no ADRs for me. Foreign stocks domiciled in America, not interested in them. Okay, and then you might have a do not trade list. For me, I don't swing trade biotechs and pharmaceuticals. I don't do it. Now, I know during the pandemic, a lot of people made a lot of money. That was a pretty unusual, black swan event, okay? I don't like biotechs and pharmaceuticals. Why? The gaps on them are obscene. Obscene. You can see a $30 pharmaceutical stock gap down to $6 sometimes. Yeah, I know the opposite happens too. I'm not interested in that. Go to Vegas if you want to do that, okay? Put your top watches and your favorites on a separate list, okay? Update and scan the universe once a week for new opportunities. I would say twice a week, but still, once or twice a week, update and scan, okay? Then you're going to put those ideas into a trade tracking spreadsheet, right? This is Swing Newsletter from a long time ago, as you can see, a few years ago, all right? And you're just going to put them in there, okay? Scalability. We talked a little bit about this earlier. Swing trades are far more scalable. Core trades are insanely scalable. Guys, core trades, you could do $1 million risk on a core trade. Realistically, I'm not kidding, right? If you're looking at something on a monthly time frame and you're going to be in it for a long time, maybe a year or two, absolutely. Let's say you wanted to buy Tesla because you think, it's at the bottom. You could easily put $1 million into that thing. Right? Maybe you have a $10, $20 stop loss call. So if you want to do $1 million risk, right? And you had a $20 stop loss, you need 50,000 shares of it. It's nothing. 50,000 shares of Tesla is nothing. Nothing. Right? Nothing. With a $20 stop loss. And then you're going to hope that thing pops, $80. Look at Barber today. Shorted Tesla at 180, got out at 120. Sweet. $60 move. Now imagine you had 50,000 shares of that $60 move. Wow. Not bad, right? Not bad. Okay, every dollar's worth 50 grand to you times 60. Pretty nice, right? $6 million or $3 million, whatever. Okay? So scalability favors swing and core trading. But you can still scale in intraday trading, right? You can still scale here. But thing I want to show you is sometimes scaling is tough. Note, a nice gap and a nice 1 minute 3 bar play that didn't work. Not all trades work. This is why we have stop losses. But this is what I want to show you guys. The entry here was 135.10. I know it's very hard to see, so I'll read it for you. There was only 6,872 shares that printed at 135.10. Okay? This was an 80-cent stop loss. Now think about that for a second. Okay? Only 6,600 shares printed. Below that, 55. Below that, 2,000. Below that, 4,300. Below that, 10,000. So basically in a 10-cent range, this stock may have done 20 or 30,000 shares. Well, if you have an 80-cent stop loss and you want to do $10,000 risk, okay, you're going to need 12,500 shares. Well, you needed nearly half the available shares, and the stock has what? A 10, 12-cent spread. It's too thin to do that kind of risk on. But if you were swing trading this with a $4 stop loss, it becomes a lot easier. Now you only need 2,500 shares. So there are certain stocks that if you're going to scale, right? And now you can see it blown up a little bit. It's the same chart I just showed you. Now you can see it blown up a little bit. How thin the stock is right in there. Look at the spread right there, 10-cent spread. This is not a scalable chart. Now, if you're doing Q's puts, SPY puts, it's very much scalable. If you want to trade Tesla or Microsoft or Apple, it's very much scalable. Now, I don't know about $30,000 risk, maybe. Certainly on the options side, probably. Okay? But then you also need obscene amounts of buying power, right? If you're going to do, let's say, Apple. You want to do $30,000 risk on Apple on a 50-cent stop loss, I mean, let's do the math. So if you're doing $30,000 risk divided by 50, you need 60,000 shares. Apple's a $132 stock. You need $7.9 million. And what's that, 920? So you need a $2 million account to take that trade. That's 1.5% risk, so it's a little bit high, right? But the point is scalability, while possible, is less scalable, right? Now, are there some examples? Yeah. Intel's a pretty liquid stock. It does 29 million shares. It's only a 16-cent stop loss, though. The problem here you're going to run into is buying power, not scalability. There's enough shares. You can get 30,000 shares of this thing. But 30,000 shares of this on a 16-cent stop loss, it's only $5,000 risk, $4,800 risk, something like that. Now, I know what some of you are thinking. Geez, Jared, you keep talking about $5, $10, $20, $30,000 risk, but I'm a new trader. I only do $5 risk, $10 risk. That's fine. I'm just showing you the future because that's probably where you want to be, right? When I take core positions, sometimes there's millions of dollars involved in those positions, right? When we take intraday trades, it's a lot less than that, okay? So it's just a balancing act of how you want to make your money, and this is why I said doing both is probably the best approach, okay? Same here. While you can make thousands of dollars on a trade, sometimes getting the shares you need is tough. But if you need 1,000 shares, 2,000 shares, not a big deal. It's only when you need the big shares, 10, 20, 30,000 shares, okay? So take a look at this for a second, all right? Here's a weekly chart on GSX. Now, this is a swing trade, obviously, right? You could swing core trade, okay? Because it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, 2.5 months, okay? The potential return was 8-1. Scaling was not a problem, okay? You could have done $10,000 risk, and it's no problem. It's 5.4 million shares, and it's a $2.50 stop loss, right? So a $2.50 stop loss, you only need 4,000 shares. Of a $20 stock, it's only 80 grand. Think about what I'm saying here. It's only $80,000, and realistically in your account, you only needed $40,000. You only needed $40,000 in your account to do $10,000 risk on this, and this stock went 8-1. $80,000 return. You could have more than doubled your account, tripled your account on this trade. Now, I'm not telling you should be risking that kind of money. I would never risk 25% of my account on one trade. I'm just simply saying you can see the scalability, okay? But here's the beauty. Even if you're doing $10 risk or $100 risk or $1,000 risk, it's the same thing. It's the same entry. It's the same stop loss. The only thing that changes is your shares. If you're doing $10 risk, you take 4 shares, right? Cost you $78 for that trade. Oh, now the people are like, oh, okay, this is starting to make sense. If I want to do $100 risk on a swing trade, you mean I only need $780 for this? Yeah, that's all you need. That's all you need. Doesn't take a lot of money to make money, right? And if you manage this out for 3-1 or 4-1 or 5-1, you could have made a pretty good amount of money, right? You could have made $300 or $400, 30-40% gain. $1,000 risk, same thing. You only need 400 shares of a $20 stock. That's nothing, right? That's nothing. Cost you $7,800, okay? With leverage, $3,900, and you could have made what? $3,000, $4,000, $5,000. So there is a lot of scalability, right? Same here. Here's BA on the daily chart, $300 by $293, and that's a tight stop. $7 is tight for a swing trade. This thing popped $50, right? $50. But again, 1 share, $300. $100 risk, 14 shares, $3,000. $1,000 risk, 140 shares. Whoops, see that? I hate that when I make a mistake. See if I did it over here too. No, I didn't. Okay, sorry. So you look at that and you're like, wow, position cost 30,000 with leverage 15,000 bucks. Well, what was the possible return? 6, 7 to 1. Say you get half that, you get 3 to 1. You made $3,000. That's a 20% return on the cash value of your account. That's pretty impressive, right? Pretty impressive. Okay. We talked about this one earlier, right? This is more of an intraday trade, but the scalability here becomes a bit different. Now you want to do $1,000 risk, but your stop loss is only 50 cents. So now you need what? $53,000. Note, on the last trade, you only needed $15,000. You needed 3.5 times less money to do the same risk level for virtually the same result. Okay? So I'm not knocking intraday trading. I'm simply saying, hey, you can do intraday trading. There's nothing wrong with it. You should do both. But most of the time, it's going to take you a little bit more money to do it. Okay? And then, oh, we already did BA. I did skip one. Okay. All right. Again, liquidity issue? Yes. This is a daily chart. Double bottom retest. Note, it broke the moving average. It broke the trend line. It put in a higher low. Wide range igniting bar on big volume, pulls back. There's a beautiful entry buy setup. Awesome. 106,000 shares though. That's the problem. This is why when I scan, I try to scan for stocks that do at least 500,000 to 1 million shares a day. Because if this stock stops out, it could be a problem. And this is a swing trade. So my point I'm making is, while swing trades are scalable, absolutely scalable, they can also have liquidity issues as well. And this is where your universe, your scanning universe, comes into play. Okay? And the Holy Grail, you know what I'm about to get to. What's the Holy Grail? There is none. But what's close to the Holy Grail? Intraday swings, right? Intraday swing trades. A stock that begins as a 2-minute, 5-minute, 15-minute chart and turns into a swing trade. These are the money plays. Why? Because you can take money on the intraday, save a quarter of your position, a half of your position, and ride this bad boy out to 60, 70, 80 bucks. Hello. Imagine getting into this with a 30-cent stop loss. Let's just say you want to do $1,000 risk on this. Okay, $1,000 risk on 30 cents is what? 3,300 shares. Okay? This thing pops up $1.50, $1.70. Okay? Think about that. So almost 5 to 1. 5 to 1 on your $1,000 risk. What do? You had 3,300 shares? Sell 2,500 of them. So you sold 2,500 of them for $1.20 gain. You made $3,000, 3 to 1. You still have 800 shares left. If this thing with 800 shares left goes up to $70, it's a $20 gain. 16,000 bucks. Think about that. 16 grand. Just manage it out, and you already have 3,000 in the bag. And I'm just saying 800 is arbitrary. You could save 300 shares, 100 shares, 2,000 shares, and this 2-minute breakout turns into a daily breakout. Okay? Same here. Beautiful level 1 gap up. Intraday 15-minute buy setup with a 70-cent stop loss. What happens? Oh my God, it goes to 156. So do the same thing, 70-cent stop loss. Let's say you want to do a $1,000 risk. You need what, 1,400, 1,500 shares, give or take? Okay, well, let's just say you sell 1,000 of them, right? This stock moves up $3, okay? And you get your 2 to 3 to 1 out of it, all right? And you hold, what do we start with, 14? Let's say you hold 400 shares, okay? This thing moved another $20. It's $8,000. $8,000. Right? That's the Holy Grail, okay? Starting off, you're trading intraday, turning it into a swing trade. 1% risk per trade, 50% per year. Why am I throwing this out there? Ollie talks about this a lot, guys, right? If you made a 50% return per year, look where you'd be. Seriously, look for a second. In year 1, you have a $50,000 account. You'd earn 25 grand. Year 2, 37. Now, granted, you're going to have to pay taxes on this stuff. I get it, guys. I get it. All right. So figure that out with taxes. Okay. Year 2, 37.5. Year 3, 56. Year 4, 84 grand. Year 5, 126. And this is when it gets good. Year 6, you have $379,000. Right? Keep adding it to your account, adding it to your account, adding it to your account, adding it to your account. By the time you get to $100,000, $200,000 in a day trading account, you're maxed out risk-wise. That's not really true. Okay, I think you could probably max out with 500,000 to $1 million. Okay, so this isn't really accurate. All right, I should readjust that. But my point is, in 5 years you have 379,000. Even if you pay taxes, your 50,000 is still going to be well over 200 grand. And that's only a 50% return per year, 50R per year, 4R per month. Wow, it's pretty impressive. Imagine if you can do 6R a month. Imagine if you could do 8R a month, 100% a year. Double these numbers. You'd nearly be a millionaire. After taxes, you'd probably be a millionaire after taxes in 5 or 6 years, starting with 50 grand. Okay, that's what's possible. All right, that's what's possible. All right. So I think, again, you're probably maxing out at $500,000 a year. Maybe you could squeeze $1 million a year due to liquidity constraints if you're intraday trading, right? Now, granted, if you're throwing options in there, different story. I'm talking about just stock trading, just stock trading, just stock trading. Okay? Probably 500,000 to $1 million a year. If you want to get past that and you want to make more than that, include options, start swing trading. Okay? The only other way around it is create a very small basket of highly liquid stocks, right? AMDs, MUs, BACs, etc. You can get, I don't want to call it unlimited shares, but you can raise that risk up to $10,000 or $20,000 a trade. Now all of a sudden, you could make a lot more money, okay? Or you could focus on expensive stocks, right? So those are some of the areas to get around some of the liquidity constraints. Either swing trade a small basket of intraday stocks, or you could focus on the more expensive stocks because 1,000 shares of those stocks could be $5,000 risk. You know, you may have a $5 stop loss on a high price stock. Okay? Those are the things to think about. Okay? So neither one is better. They're merely different. Neither is better. They're just different. So you need to make more on your swing trades because time value of money, right? If you're trying to equal what an intraday trader would make, you need to make more on your swing trades because there's lower frequency. And the lower frequency also generally means you're holding those positions for longer periods of time. Days, weeks, and months, right? Whereas intraday trading, you're in and out, in and out. You get to reuse the same capital over and over and over again, okay? Risk exposure to gaps by holding overnight. You need to account for that, okay? Lower frequency I just talked about. And the 1% risk rule is harder because leverage is lower. It is if you're in a lot of positions, okay? So again, I'm not saying don't take swing trades. I'm saying these are some of the considerations. Notice there's positives and negatives of both. And it goes all the way back, and I'll bring it up, all the way back to this slide right here. What's your life like? Meaning, what are your personality traits? What are your time constraints? Capital restraints, okay? Intangibles. You need to sort this out first, and then that should give you a pretty clear-cut answer of whether or not swing or core trading is better for you, okay? And then, like I say, and I'll continue to say to the end of time, doing both is usually best. But when you're new, I would focus on one or the other. The transition to doing one or the other is pretty simple because once you learn the patterns are the easy part. After that, it's just tweaking your management, tweaking your scanning a little bit, okay, and tweaking your trade management as well, okay? So I hope you guys learned a little bit about the difference between intraday trading, swing trading, core trading, maybe even intraday swings, etc., and so forth. Hopefully you can apply this to your own trading to help you be a little bit more successful and profitable. I am Jared Wesley of Live Traders. We'll get back at it again next week.